Ladies and gentlemen, good day and welcome to Cantabile Retail India Limited Q1 FY25 earnings conference call. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Before we begin, a brief disclaimer. The presentation which Cantabile Retail India Limited has uploaded on the stock exchange and their website, including the discussion during this call, contains or may contain certain forward-looking statements concerning Cantabile Retail India Limited business prospects and profitability, which are subject to several risks and uncertainties, and the actual result could materially differ from those in such forward-looking statements. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vijay Bansal, CMD of Cantabile Retail India Limited. Thank you, and over to you, sir.
Good afternoon, everyone. On behalf of Cantabile Retail India Limited, I welcome everyone to the Q1 FY25 earnings conference call of the company. Joining me on this call is Mr. Deepak Bansal, Full-Time Director, Mr. Basant Goyal, Full-Time Director, Mr. Surendra Nigam, CFO, Ms. Poonam Chahal, Company Secretary, and Madsen Capital, our Investor Relation Advisors. I hope everyone had an opportunity to look at our results. The presentation and result release have been uploaded on the stock exchange and our company's website. FY25 has started on a positive note with company delivering a double-digit volume growth of 18.5%. The company also achieved a positive SSG. This growth despite a lower wedding season demand and heat wave conditions specifically in North India, demonstrate the trust of our customers in our business model and the brand. We see a strong demand rebound with onset of festival season in Q3, followed by wedding and winter season. We are confident that this business is well poised to shift gear and deliver substantial value to customers and shareholders going forward. I now hand over the...
Ladies and gentlemen, we have lost the management line connection. Please stay connected while we reconnect them. Thank you. Thank you for patiently holding. We have the management back on the call.
Thank you, sir, and a warm welcome to everyone. Coming to the financial, standalone performance highlights for Q1 FY25. Revenue from operations for Q1 FY25 grew by 14% to 127.9 crore as compared to 111.8 crore in Q1 FY24. EBITDA for Q1 FY25 also grew by 14% and stood at 39.4 crore as compared to 34.4 crore in Q1 FY24. EBITDA margins for Q1 FY25 stood at 30.8%, similar to Q1 FY24. PAT for Q1 FY25 stood at 11.4 crore as compared to 12.3 crore in Q1 FY24. PAT margin for Q1 FY25 stood at 8.9%. With a firm belief, we opened 11 stores during Q1 FY25. With this, the store count as on 30th June stands for 544 retail stores, out of which 414 was a COCO store and 130 as a franchisee-owned stores. The total retail area what we serve is 6.8 lakh square feet. With the approval of the board, board has approved Messrs Walker Chandiok and Company LLP as our statutory auditors. We may now begin our question answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, We will wait for a moment while the question queue assembles. The first question is from the line of Rajesh Sharma from Anand Rathi Group. Please go ahead.
Good afternoon, sir. Am I audible?
Yeah, please.
Yes, sir. So I had just two main questions. So what would be our volume guidance for next year, and what growth are we expecting? And is there any specific reason for increasing depreciation this year?
Okay. So volume guidance for overall year will depend on our turnover. So what we have been predicting, the same. Last year, we made a volume of approximately 60 lakhs. So this year, in the same ratio, in our sale, which would be approximately 15 to 18%, should grow as well. As far as depreciation is concerned, this depreciation is mainly on account of Ind AS 116, because last year we opened more stores, company-owned stores. Earlier, we were maintaining approximately 50 to 55 company-owned stores. Now, last year we opened 84 in fact, company-owned stores. So Ind AS impact is slightly more on the PAT as well. So that is what the main reason is.
Okay, sir. Thank you, and all the best for the coming quarters.
Thank you, sir. Thank you.
Thank you. The next question is from the line of Vikas, an individual investor. Please go ahead.
Good afternoon, sir. So just a couple of questions. A follow-up to the first answer which you mentioned in terms of the volume growth. Out of this volume growth of 15-18%, how much do you see coming from SSG and how much do you see coming from the new stores? If you can give some sort of a guidance on the SSG as well as the new store growth.
So, despite the market conditions, we have registered a positive growth in terms of same-store sales. So this year also, out of this 16% overall growth, 4 to 5% we can say would be expecting from the same-store sales growth, and balance is coming from the new stores as well as slight increase in the e-commerce shares.
And what would be the target by the end of this financial year in terms of the store count?
Same, approximately 70 to 80 stores we are targeting. First quarter was slightly on the lower side due to properties. So 11 has already been opened. So at the end of the day, we should be ending at approximately 70 new stores for the financial year.
Okay. And so sorry, but just a very, very fundamental question, and this is more from an understanding from your business model perspective. Where do you as management aspire to be? Do you want to be on the likes of the value retail chain aspect of the retailers, or someone like the premium retailers like the Shoppers Stop or the Lifestyles of the world? So where do you see Canterville Retail standing between this entire grid?
Yeah, if we see like our average selling price for a product is around 1,040 rupees. So we are neither in the value format nor in the premium segment. So we call our asset the mid-premium segment, because ASP in the value segment is around 500-600 rupees, and the premium segment ASP of the product is around 1,800 rupees, and we are standing at around 1,040 rupees. So it's a between the both formats, and we call it mid-premium segment.
Okay. Thank you so much, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Jachin Chawla from RTL Investments. Please go ahead.
Yeah, hi, good afternoon. Couple of questions. So one, you said that you're expecting growth from 3Q with the festive season. How are you seeing things right now in 2Q? Is it still, are the market conditions still tough, and should we expect a similar sort of quarter, flattish SSG kind of quarter?
Yeah, there will be marginal growth. It will be something like Q1. So that's why we are saying that a major change will be coming from the Q3 onwards only.
And for the full year, you are still then targeting 4-5% SSG, which will mean that in 3Q and 4Q, you actually need like almost like 10% SSG. Is that something that looks realistic?
Yeah, in Q3, because wedding dates are more, so we are hoping that SSG will be quite good in Q3. So, and Q4 also had many wedding dates in January, February. So we hope that business will be really good in those times to cover up the backlog of the first 2 quarters.
Got it. Got it. A related question, when I look at your revenue per square feet, that has fallen significantly over the last 2 years from like almost 730 rupees per square feet to now almost close to 625, 630. And that is obviously, putting pressure on your margins. So how do you plan to arrest this decline that we are seeing on revenue per square feet? Because you're opening larger stores, so the SSG number is not looking that bad. But when I look at revenue per square feet, that number is kind of falling significantly.
Yeah, our store size has increased. Last year, our average store size we opened was 1,600 square feet, and this time also on first quarter, average store size was 1,400 square feet, which we opened. And company average store size is 1,250. So we are opening stores bigger than the company average. But we have checked the retail cost of the family stores. Family stores and the bigger stores have a retail cost lesser than what the men's stores or the men's and ladies stores having. So, though the per square feet sale is less, but at the same time, retail cost is lesser than the smaller formats. So,
What are the...
Sorry?
No, sorry. Go ahead. Finish. I have a follow-up question. Yeah. So first you finish.
We can conclude that profitability is better in the bigger stores, though the per square feet sale is less, the profitability is higher in the bigger stores.
And when you say so in a family store, your costs are lower. What elements of costs are lower? I would assume with a larger store, it could either be same or slightly higher.
Rental per square feet is going down. Like we have an average rental per square feet of 128 rupees last year, and last year our average rental per square feet came down to 122 rupees. So when companies take a bigger properties, our per square feet rental used to fall.
Got it. And other operational costs like rent, employee and
They also have impact. So it's the same thing. Once your revenue coming down, so obviously your per square feet cost in terms of mainly two, the rentals is visible as well as salaries.
Got it. Thank you.
Thanks, Chetan.
Thank you. The next question is from the line of Piyush Ahuja from Congruence Advisors. Please go ahead.
Good afternoon. Just wanted to understand the demographic in terms of age of our overall customer base and reason behind the stickiness of our customer as we have 50% repeat customers. Thank you.
So, what I understand, you want to understand the customer profile basically, right?
Yeah, demographics in terms of age group.
Demography is like a bigger range. So we have a demographic something between 20 to 45 because we are majorly into the basic fashion. So all kind of customers come to us. It's young customers also coming to us and the middle-aged customer also coming to us. So it's a bigger bracket of the age group.
And the reason behind the stickiness of 50% repeat customers?
So this is a phenomena which is seen in the last few years. That 50% is the old customer and 50% are the new customers. So old customers are the ones who have purchased any time at least once in the Cantabile from history. So that's how we are calculating the data.
No, just wanted to ask the reason behind the stickiness, customer stickiness.
So that's why that is showing the strength of the business as well. Now it's a very fine balance for the Cantabile concern because it is not only important to have old customer repeat as well as new customers. So we have been analyzed this number in last 4-5 years. Earlier my number was 3 years back was 44% repeat, then 2% everyone increased. So it's a good chance that the new expansion happening, new customer is adding as well as new repeat is in. So that is what and as far as reason is concerned, brand for the Cantabile is quite acceptable.
Thanks. Thank you, sir.
Thanks.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Prathamesh Diwar from Tiger Assets. Please go ahead.
On the geographical front, So, in coming time, are we planning to also tap South markets?
Sorry, your voice is, we didn't get that question. Can you repeat?
Yeah, am I audible?
Yeah, now.
Yeah. My question was on the geographical front. So I think mostly we are present in the upper side of the India. So in coming time, are we looking to expand our more stores in South?
Yeah, in the near future, we are not planning to go to the South India. Maybe after 2 years, we plan to go to South India. So right now, we are planning to expand in the current territories only.
Mr. Again, what's our guidance in terms of revenue and EBITDA for FY 25?
So FY25 same, overall, we are targeting to have a growth in terms of revenue, approximately, as just I answered earlier question, 16 to 18%. And by this, we are maintaining our gross margin and watching very close monitoring the gross margin, and then we should be able to back on our EBITDA margin, pre-Ind AS approximately 17-18%, which post-Ind AS you can take 27-28%. We are targeting these numbers.
Okay. Okay, thank you so much, sir, and all the best.
Thank you. The next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Thank you for the opportunity, sir. Sorry if I'm repeating. I joined the call a little late. So how many stores do you plan to open in this year?
We plan to open like 80 to 85 stores in the current financial year, and in the first quarter we have opened at 11 stores. So rest will be coming in the next coming quarters.
And sir, our SSG has been positive. So is it that our sales are not related to wedding days, number of wedding days, and that doesn't affect us? Because a lot of players have said that that has really affected their revenues this quarter.
Wedding dates affect us because we used to sell suit, blazers, and definitely when there is wedding, people used to buy shirt, trousers, and other kind of things for gifting also. So if wedding dates would have been more in the last quarter, then definitely our SSG have been better than what we have given.
Okay. And sir, do you expect pickup, are you witnessing sequential pickup, month-on-month pickup in SSSG in the upcoming quarters, also in Q2, or how do you expect SSSG to turn out in H2?
So it's too early to say because only 1 month has passed. July was a positive SSG. So let's see by the end of the quarter how it goes.
Okay. And sir, if I look at your segmental breakup, how do you see this women kids and accessories contributing in, say, 2 years from now? Because our contribution from all these categories is increasing. So how do you see it panning out in next 2 years?
Yeah, like our contribution from the ladies category was 10%. So from the 2 years it will come to 15, and kids category can double up because it's a very small 2.5. So kids category contribution can double in next 2 years.
Oh, that's really good to know, sir. Thank you for the opportunity, and all the best for the future.
Thank you. Thanks, sir.
Thank you. The next question is from the line of Shrinjana Mittal from Ratnatraya Capital. Please go ahead.
Hi, good evening. Thank you for the opportunity. Just couple of questions. So one is that for how do we do our calculations for same-store sales growth? Like what is in the denominator? What stores do we take? Like which were open like 2 years back or 1 year back? How is the math? Can you explain that, please?
So same-store sales growth is purely on the pro rata basis. The stores which like open in between the last year, if like a store has been opened in last year June, so it worked for the 9 months. So this year also we calculate for the 9 months only. So it's not kept that if store is opened in the middle of the year, so we take this year comparison with the full year sale. We automatically reduce that much months from that sale of the store.
So for June 24, like for this quarter, for example, in the denominator, the stores would have been open Like when would they have been opened?
Last year. So simple. The store which has been opened, say in a month of May, then only the month of May, June last year, as well as May, June sale of this year has been considered. So last year versus this year.
Okay, got it. So 1-year-old stores.
Yeah.
Okay,
Yeah.
understood. And on the e-commerce side, Shirendra ji, can you please share like what was the share of e-commerce in this quarter sales?
So this year, out of this total revenue, we have a 7.13 CR of the slight increase of 10%. Last year it was approximately 6.5. This year, in this quarter, it has been done at 7 CR.
Okay. And what was it for Q4 FY24 e-commerce sales?
Q4 FY24.
Yeah.
I need to just recall that number. That is approximately 9 CR, I think. I need to just recall those numbers specifically for the quarter last year. I'll just let you know.
Yeah, no worries. And just one more question. So for like it was asked previously as well. So for wedding dates, what percentage of our sales gets affected because of the wedding season, like in terms of the mix and the suits and all? So what percentage of our sales get impacted?
So the three categories, suit, blazers and the waistcoats, which are directly related to wedding, contribute 15% of the Cantabile sales. But yes, we cannot ignore the shirts and the trousers for the wedding season sales also. So in the range of 20 to 25%, we can easily say the wedding season contributes.
Understood. Thank you for taking my questions and all the best.
Thank you.
Thank you. The next question is from the line of Rajesh Jain from Jinath Research. Please go ahead.
Yes, good afternoon, sir. Thank you for taking my questions. I have a couple of questions. First is, like we have recently added footwear. Here I would like to know how is the response and how many stores do we have currently and what is our future plan for that. My second question is related to the breakup of COCO and FOCO stores and the targets for current and the next year, sir.
Yeah. Footwear stores last year we did was 2.6 crores, and this year we're targeting the footwear sales of 10 CR. Till last year we put footwear into the 60 stores. Now we have put it into the 90 stores in the company. So, okay. And regarding the COCO and the FOCO stores, 414 stores are the COCO stores and 130 is the FOCO stores.
Okay. What is the target for current year and next year in this breakup?
So it will be again, FOCO stores will be between 20 to 25 and rest will be the company stores.
Okay. Thank you. And best of luck, sir.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Yash Bajaj from Lucky Investments. Please go ahead.
Hi. Good afternoon, team, and thanks for the opportunity. Sir, you just in answering one of the previous participants, you mentioned that you're opening new stores with bigger stores, and they are relatively much more profitable because of the rental savings. So, my first question is that is the profitability you're seeing today for these new stores, are they profitable at a lower sales per square, much more profitable at a lower sales per square feet versus the company average? That's my first question.
So what I understood about your question, whether overall profitability, there are two things. What I understood, number one, we can look at the numbers in percentage or we can look at the number in totality, right? So once we are looking in percentage, obviously slightly on a percentage side would be down like per square feet sale, but at the same time per square feet cost is also coming down. So on a totality basis, on a EBITDA level at the company level EBITDA would obviously high once we are opening the bigger stores.
Okay. Okay. And my second question is that the new stores which have been opened, at what additional sales per square feet they can go versus the current numbers?
So it's the same thing. Now the overall, because when we are looking the history of our per square feet, we are not saying it is more because earlier the store size was less. So now, like just give an example, we have a very exclusive stores in Delhi itself of the 3,700 square feet, right? So when you go to per square feet, slightly number. So it is too early going forward 3 to 4 years, how much will be the reduction in per square feet? We are trying to increase it. So overall it would be maintained around this figure on an annual basis.
Okay. Got it. Okay. Thank you, sir. And all
yeah, thank you. Thanks. Yeah.
Thank you. The next follow-up question is from the line of Jatin Chawla from RTL Investments. Please go ahead.
Yeah, hi. Thanks for allowing the follow-up. The question is linked to, I think, something that we discussed on the last call as well, that, last year you opened very few franchisee-owned stores. Most of the stores were company-owned. And your response was that, while you were opening stores in Rajasthan, where the brand was strong, you were getting a lot of franchisees who were willing to open stores. So are we seeing any sort of that kind of traction in any other state? We are expanding a lot in UP, for example, or any other state where we are seeing that franchisees are now coming forward and, willing to open more stores. Because you said this year you are looking 20 to 25 stores coming from the franchisee route.
See, Canterbury from the very beginning has been a company-owned store kind of format. Between around 2016 to we even closed the franchisee format. We came back with the franchisee format around 2018 only. So right now, the most of the company stores we are doing very well. So when we open company store, our profitability in beta margins are also high. So, but yes, if there is any good option with the franchisee, definitely we go for, because there is no meaning of losing a good opportunity. But yes, the traction which Rajasthan has is we are not there with the other kind of markets. And we frankly are not targeting many franchisee stores also. But yes, good options come this quarter also. We opened 2 new franchisee stores. But that were good options and doing well. So franchisee will be overall between 20 to 25 only. That's why I said it will not be increasing. I give a lesser figure only because 25% we have. So it might come down, but it won't increase.
Got it. In this 20 to 25 franchisee stores, are you looking at any particular state where these might come up, or?
No, it will be scattered everywhere, not so many particular states.
Understood. So where I was coming from was, a franchisee is going to come and ask for a license to open only when the brand in that region is strong. So if we are seeing any particular state where there is a lot of franchisee requests, that at least to me tells me that, the brand is finding strong traction in that state.
No, it's nothing like if franchisees are not coming, we can say the brand is weak. Brand is doing very well in most of the markets. And only the Rajasthan has the maximum franchisee. Brand is much stronger in Delhi, and we don't have any except one franchisee in Delhi. So it's a matter of trend also. One state sequence starts building up within the franchisee. So that's it. I don't see if a franchisee is not coming from any state, so brand is weaker here. We are doing good in the territories we are holding today.
Understood. Thanks a lot for
Thank you, Jatin. Yeah.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Aman, an individual investor. Please go ahead.
Hello.
Okay. Yeah.
Am I audible, sir?
Yeah, please.
I had a fundamental question regarding our business. Basically, if I talk about this Q1 of FY25, our same-store sales growth was 1.2%, while our volume growth was 18%, right? So, if I say we are boosting our business by the means of adding stores, while our same store sales growth are like flattish or similar kind of thing. So, if we reach at a saturation point in any state, so what will be our plan to increase our sales? If I say we are on flattish mode on same store sales growth, so in that situation, if the base effect comes out, so how we will take care of that?
So right now, what we have seen, the stores which are coming on near the expiry, where lease terms are getting completed. So we are taking the bigger stores. So and it is giving very good reward to the company, because when we are opening a bigger store after the completion of 9 years lease, our sales get increased multifold. So that's how we are planning to increase the sale in the states which have gone near saturation. And no particular state literally go for saturation. There are always some opportunities coming up in the states which look to be saturated. So yeah, the company will be keep growing in the territories that we are strong, and new territories, so definitely company will grow where we don't have presence.
But if I say in Delhi, we are at 56 kind of number in stores. Yeah, right. So is we can say, are we at a saturation point in Delhi, or is it wrong to say?
No, we are not near saturation point in Delhi NCR. Like we have recently opened a Kamala Nagar store which was around 700 square feet, and we have now increased it to 3,800 square feet. And we are repeating the same thing in Lajpat Nagar, where store was around 550 square feet, and we have taken now 2,000 square feet. So it is we are planning the same thing in many other markets also in Delhi. And new markets are also, we are tying up, like there was a Moti Nagar market which has come up in Delhi. There is many new markets coming up in the NCR, especially in the Noida and the Gurgaon regions. So that's why I said there's no territory comes near complete saturation.
Okay. Thank you. Thank you for answering my question.
Thank you.
Thank you. The next question is from the line of Adrian Viegas from Ginanath Research Analyst. Please go ahead.
Hi, thank you for this opportunity. I had a few questions. Firstly, with the business growing, do you have any plans to get into athleisure as a segment? That would be my first. Also, what's the contribution of non-apparel to the total business? And what is the per square feet sales that we are targeting for current year as well as for next year? Yeah, these are my questions.
So we have been into the active wear. So in the last year only we have introduced the active wear and the athleisure category. So and our per square feet sale was 800 rupees last year, and we are targeting 5% increase in the per square feet sales. So that was for the same stores, I mean.
Okay.
And the apparel business accessories contribution in the total business is 5%. That's the number, and we hope it will also increase.
Okay, sir. Thank you for this.
Thank you.
Thank you.